Intellectual capital represents the organizational knowledge base that drives innovation, competitive advantage, and long-term value creation. It includes intangible assets such as patents, trademarks, software, systems, and databases, as well as tacit knowledge, corporate culture, and processes that enable efficient operations. While IAS 38 Intangible Assets governs the recognition and measurement of certain intangibles, it applies strict criteria. Assets must be identifiable, controlled by the entity, and expected to yield future economic benefits. This excludes internally generated goodwill and most knowledge-based resources, creating a significant gap between reported and actual intellectual value. Integrated reporting therefore expands the view of intellectual capital to encompass non-recognized intangibles that underpin organizational resilience and innovation. Measurement challenges arise because intellectual capital is rarely separable from human or organizational processes. Market-based valuation, replacement cost, or income approaches may estimate value, but these methods rely heavily on assumptions and judgment. The absence of universally accepted metrics for knowledge assets limits comparability across entities and industries. Consequently, integrated reports rely on narrative and qualitative disclosures to explain how intellectual capital contributes to strategy, performance, and future prospects. Examples include research and development expenditure, innovation indicators, and digital transformation achievements. Such disclosures enhance transparency about how knowledge and technology drive sustainable value beyond what is captured in traditional financial statements. Disclosure issues focus on connecting intellectual capital to business outcomes. Organizations must explain how their intellectual resources, brands, processes, and technologies support customer satisfaction, operational efficiency, and competitive differentiation. The IR framework emphasizes describing how intellectual assets are developed, protected, and leveraged to create long-term value. For example, disclosing innovation pipelines, intellectual property management strategies, or cybersecurity investments demonstrates stewardship over intangible resources. These disclosures also help investors assess innovation risk and growth potential, making them crucial for performance evaluation in knowledge-based economies. Integrated reporting encourages organizations to describe interdependencies between intellectual and other capitals. Knowledge systems often amplify human productivity and strengthen social and relationship capital through better stakeholder communication. Similarly, investments in digital systems reduce environmental footprints by optimizing resource use. Effective disclosure requires a balance between transparency and confidentiality. Too much detail may compromise competitive advantage, while insufficient information undermines credibility. For finance professionals, the key is articulating the value narrative, how intangible knowledge creates tangible outcomes, linking strategy, innovation, and performance. Intellectual capital measurement thus shifts focus from recognition on the balance sheet to understanding how organizations nurture, apply, and renew their collective intelligence.